Duolingo just reported a quarter that, on paper, looks pretty strong. Revenue was up 27% year-over-year to $292 million. Paid subscribers grew 21% to 12.5 million. Daily active users grew 21% to 56.5 million. Adjusted EBITDA was up 33% to $83.4 million. And free cash flow jumped 43% to $147.8 million. So you might look at that and think, okay, why did the stock sell off? And that's really the story here. Because this quarter was not about whether Duolingo is profitable. It is. It was not about whether the company is still growing. It clearly is. The debate is whether Duolingo is still a hyper-growth consumer platform or whether it is now settling into a slower, more mature growth phase. And for a stock like DUOL, that difference matters a lot. Before we get into it, if you enjoy breakdowns like this, make sure to like the video, subscribe, and drop a comment with your thoughts on Duolingo. I'm curious whether you see this as a high-quality growth stock on sale or a company that's starting to lose momentum. So let's start with the headline numbers. Duolingo's revenue grew 27% year-over-year to $292 million. Subscription revenue, which is the core of the business, grew even faster at 31%, reaching $250.9 million. That's important because subscriptions are what really drive the model here. Ads, the English test, in-app purchases, all of that helps. But the main engine is people converting from free users into paid subscribers. Paid subscribers reached 12.5 million, up 21% year-over-year. Daily active users were 56.5 million, also up 21%. So the app is still getting more usage, and the paid base is still expanding at a healthy rate. But then we get to bookings. Total bookings were $308.5 million, up 14% year-over-year. On a constant currency basis, bookings were up only 9%, and full year 2026 bookings guidance implies growth of just 10.5%. That's the number investors are reacting to. Revenue looks strong today, but for a subscription business, revenue is partly a backward-looking metric. Annual subscriptions are recognized over time, so revenue can keep looking good even after bookings growth starts cooling. Bookings give you a better read on what future revenue growth might look like. And when bookings growth is running at 14%, with guidance pointing to around 10.5% for the full year, it becomes much harder to value Duolingo like a fast-growing software-style consumer platform. That doesn't make it a bad business, not even close. It just changes the setup. What makes this more interesting is that management is not simply saying demand is weak. Their message is more intentional. Duolingo is choosing to prioritize product quality, learning outcomes, and free user engagement over squeezing more monetization in the short term. In plain English, they're saying, we could probably push harder on paid conversion right now, but we think the bigger opportunity is to make the product better, grow the user base, and monetize that larger base later. That is a reasonable strategy, maybe even the right one. The tricky part is that investors have to wait for proof. Management still has a medium-term goal of reaching 100 million daily active users in 2028. Right now, they're at 56.5 million, so there is still a big gap between where the company is today and where management wants the platform to go. If they get there, and if those users eventually convert into paid subscribers at attractive rates, then today's weaker bookings growth could just be a temporary trade-off. But if user growth keeps slowing, and paid conversion doesn't improve, then this starts to look less like long-term patience and more like natural deceleration. That's the debate. Now, one part of the quarter that I actually thought looked very strong was profitability. Gross margin improved from 71.1% to 73%, helped by lower per-unit AI costs. Adjusted EBITDA margin came in at 28.6%. Free cash flow margin was 50.6%. Those are excellent numbers. For a company still investing heavily in AI features, speaking practice, and new content, that kind of margin profile tells you this is a real business. This is not one of those growth stories where everything depends on some future version of profitability. Duolingo is already profitable, already generating cash, and already showing operating leverage, but there is some context needed. Management expects gross margin to move lower through the year, toward around 69% by the fourth quarter as AI feature usage expands. So I wouldn't take the first quarter gross margin and assume that's the new normal. AI can improve the product, but if users are using more AI-heavy features, there are real serving costs attached to that. The question is whether those costs translate into better retention, higher conversion, or stronger pricing power over time. And this is where Duolingo's product strategy becomes really important. One of the biggest gaps for Duolingo historically has been speaking practice. A lot of people use Duolingo, enjoy it, build a habit around it, maybe learn vocabulary and grammar, but speaking is a different level of confidence and usefulness. In the quarter, management highlighted several speaking-related features. Video call is now becoming more central, and average words spoken per user have more than doubled over the last year. Video call access has expanded to super subscribers. They're also adding spoken tokens, flashcards for spoken recall, and speaking adventures, where users complete real-world speaking tasks with Duolingo characters. That might sound like just another feature list, but strategically, it matters. If Duolingo can make users feel like they're not just playing a language game, but actually getting better at speaking, the product becomes more valuable. That could improve retention. It could support paid conversion. It could strengthen the brand. And longer term, it could help Duolingo move closer to being a serious learning platform, not just a fun daily habit. That is probably one of the most important long-term pieces of the thesis. The other big piece is AI-driven content creation. Duolingo launched content up to Duolingo Score 129, or CEFR-B2, across courses teaching its 9 most learned languages. It also published 20,500 course units in the first quarter. For comparison, that was 7,100 per quarter in 2025 and 1,800 per quarter in 2024. That is a huge jump. And this is where AI is more than just a shiny feature. It's changing the company's production function. Duolingo can create, test, and update learning content much faster than before. That can help expand courses, improve lesson quality, and support more advanced learning paths. Management also called out improvements in Chinese, Japanese, and Korean courses, especially around making character-based learning more approachable. Those are difficult but popular courses, so better early course design could matter for retention. Then there are mastery checks, where users complete a session at the end of each unit before moving forward. That pushes the product a little more toward learning outcomes instead of pure engagement. And then you have the optionality pieces: chess, math, and music. I wouldn't underwrite the stock based on those yet. They're not the near-term financial driver, but they do show how Duolingo is thinking about itself. This is not just a language app trying to maximize ad load or subscription prompts. The company wants to become a broader consumer education platform. That is exciting, but it also adds execution risk. New categories can create upside, but they can also distract from the core language learning business if not managed well. Now, let's talk valuation, because this is where the sell-off changes the conversation. At $104.03 per share, Duolingo's market cap is about $4.81 billion. The company has roughly $1.39 billion in cash and investments, which puts enterprise value around $3.42 billion. Using full-year 2026 guidance, that means Duolingo trades at around 2.8 times enterprise value to revenue and around 11 times enterprise value to adjusted EBITDA. That is not crazy for a profitable, high-margin consumer subscription platform with a strong brand and a huge net cash position. A few months ago, the valuation debate may have been much tougher. But after the stock drop, the numbers look a lot more reasonable. Still, reasonable does not automatically mean cheap. If bookings growth stays around 10% for several years, then the stock is probably just fairly valued. You would own a profitable, high-quality business, but not necessarily one with explosive upside. The upside case requires bookings growth to re-accelerate, not just revenue growth. Bookings, because if bookings move back into the high teens or 20% range, while margins stay strong, then the current valuation could end up looking very attractive. The 5-year scenario analysis makes this pretty clear. In the base case, Duolingo grows revenue at around 14% annually through 2031. Revenue reaches about $2.32 billion. Adjusted EBITDA margin reaches 30%, giving about $695 million of EBITDA. Apply a 14 times EBITDA exit multiple, add about $2 billion of net cash, and assume roughly 56 million diluted shares. That gets to a projected share price of around $209 in 5 years, from $104.03 today. That would be about 101% upside, or roughly a 15% annualized return. That's a solid base case. Not guaranteed, obviously, but attractive if you believe Duolingo can sustain mid-teens growth and strong margins. The bull case is much more powerful. If Duolingo reaches or exceeds 100 million daily active users by 2028, speaking practice improves retention, paid conversion gets better, and revenue compounds at around 18% annually, then revenue could reach about $2.75 billion by 2031. With a 33% EBITDA margin and an 18 times EBITDA multiple, the projected share price would be around $336. That would be about 223% upside from today's price. That scenario is not impossible, but it requires the engagement-first strategy to really work. Duolingo has to prove that better learning quality creates better monetization later. The bear case is not a disaster scenario, which is actually important. If bookings growth stays weak, user growth slows, and revenue compounds at only 8% annually, then 2031 revenue could be around $1.77 billion. With a 24% EBITDA margin and a lower 9 times EBITDA multiple, the projected share price would be around $91. That's about 12% downside from today's price. So the bear case is not bankruptcy, it's not business collapse, it's mediocre growth, plus multiple compression. That makes sense because Duolingo has a strong balance sheet, high margins, and real cash generation. The company is not fragile financially. The bigger risk is that investors stop viewing it as a premium growth platform. And that brings me to the main risks. The first risk is bookings deceleration. This is the big one. If bookings remain near 10%, future revenue growth will likely keep moderating. Second, user growth has to stay healthy. Management's 100 million daily active user target by 2028 is ambitious. If Duolingo falls meaningfully short, the long-term monetization base becomes less exciting. Third, the monetization trade-off could backfire. Improving the free product may be the right move, but if it suppresses bookings for too long, investor confidence could fade. Fourth, AI costs need to be watched. AI can improve the product, but if usage grows faster than monetization, margins could come under pressure. And finally, dilution is real. Management expects stock-based compensation to be nearly 15% of revenue in 2026, and diluted share count is expected to rise 3.5 to 4% before buybacks. Buybacks help, but SBC is still an economic cost, so where do I land? I think Duolingo is a high-quality business. The brand is strong, the balance sheet is excellent, profitability is already proven, and the product roadmap actually makes strategic sense. Speaking practice, AI-generated content, mastery checks, and broader learning categories all support the idea that Duolingo can become more valuable over time. But I also think the market is right to focus on bookings. This was a financially strong quarter, but not a clean growth quarter. Revenue, EBITDA, and cash flow looked great. Bookings and guidance created the doubt. At around 2.8 times 2026 enterprise value to revenue and about 11 times enterprise value to adjusted EBITDA, I'd call the stock fairly valued to modestly undervalued. Not a screaming bargain, not low risk, but much more interesting after the sell-off. For me, this is a bullish to neutral-leaning bullish setup. The business quality is high. The valuation is now more reasonable. The balance sheet provides downside support. But the next phase of the stock depends heavily on whether management can turn engagement and better learning outcomes into faster bookings growth again. That's what I'd watch most closely next quarter. Bookings growth, daily active user growth, paid subscriber growth, gross margin, AI feature adoption, and any commentary about acceleration in the second half of the year. If those pieces start moving in the right direction, Duolingo could become a very compelling long-term growth story again. If they don't, then this may simply be a good business growing slower than the market once expected. And that's the tension with DUOL right now. High-quality company, better valuation, real upside, but the stock needs bookings to prove the story. If you found this breakdown helpful, hit the like button, subscribe for more stock analysis, and let me know in the comments. Are you buying the Duolingo dip, or do you think the slowdown in bookings is a bigger warning sign?